Live from New York City this morning. Good morning, good morning. Big debate about recession, and then jobless claims come in at 190K, 190,000. Futures negative. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York coming up. Tech results kicking off with Netflix after the close. Jobless claims data in America defying the gloom as the Fed leans harder towards smaller rate hikes. We begin with a big issue. Bonds starting to behave like bonds.
Bonds are going to be your friend.
I definitely like bonds more than stocks.
There is the potential now for bonds to offer diversification benefits.
Inflation is on its way down. The economy is slowing.
Things are slowing down.
We're looking at economic data.
Very aggressive central bank tightening and quantitative tightening are starting to bite the economy, and they're biting hard.
All of those factors should suggest that high-quality bonds will produce positive returns.
Investors are making the decision, get me into bonds.
One thing about fixed income, and this is the boring part of fixed income, it's the income.
Bonds could be 4 to 7% return this year.
That doesn't happen when yields are close to zero.
It is an environment in which bonds are cheap again.
You get a yield that each day accrues as each day ticks forward.
The attractiveness of bonds going into the rest of 2023 has surged.
Let's start a conversation right now with RB's Mike Contopoulos and Zach Griffiths of Credit Sites. Zach, I want to start with you. 2 points. Bad data. Bad news is bad news. Good data, good news is good news. And finally, bonds responding to that news in a way you'd anticipate. Are we making a breakthrough here?
Yeah, John, it's tough to say. I feel like we go from good news is good news to good news is bad news on a day-to-day basis. And when we think about sort of the recent data this week, you definitely saw some softness in retail sales. You're starting to see softness on a consistent basis on the manufacturing side. So that's concerning in a way, but we think it's consistent with the Fed having tightened as much as it has and consistent with a downshift in economic growth in 2023. But we think if the Fed does what we're calling for and hikes just 25 more basis points in February and holds from there, we think we can avoid a recession in 2023, creating a great backdrop for fixed income.
Well, let's start by talking about the data, Mike, and then we can get to how the bond market's responding to it. How bad is this data? Yesterday, I get it, industrial production, retail sales. This morning, jobless claims at 190,000. That does not scream recession, Mike, does it?
It doesn't, Jonathan. I mean, listen, you got to differentiate between the data today versus the data in 6 months, 9 months, 12 months from now. And of course, the market's forward-looking. So the market should not be trading on, today's data. I mean, look at, GDP now, for example. I think it's north of 4% at this point. But rather what's going to happen in the back half of 2023 or into 2024. And I think that's what the bond market is telling you, is that the data is okay today, but it's clearly deteriorating and has been for some time. I mean, you have ISM new orders, PMI manufacturing, look at Empire the other day, retail sales, really everything other than labor is certainly weakening, but you got the service side of the economy that's running hot. And that formula of a hot labor market with weak other economic data is the perfect recipe for fixed income, in particular treasuries.
So with that in mind, for the same reasons you like treasuries, Mike, shouldn't you hate credit? What business does high yield credit have rallying into survey data that is showing sub 50 prints on the ISM?
It's pretty ridiculous, Jonathan. I mean, listen, I think there's a lot of technicals going on in the high yield market. You've had next to no issuance, which in and of itself, by the way, is a really bad sign. In our default model, issuance is a big factor into our default model. When you have low issuance, you have huge risk aversion. Risk aversion is usually bad for high yield. But perversely, what's happened is most high yield portfolio managers have high cash balances at the moment. They're not paid to manage cash. They're paid to manage high yield. You've got coupons that are coming due, and you got to put that cash to work, and there's no primary market to do it. So it gets recycled into secondaries, and that ultimately pressures spreads lower. That can only last so long in the face of deteriorating economic data, deteriorating fundamental on the corporate side. Listen, we're about to enter into an earnings recession. low quality never does well in an earnings recession. So the whole "this time is different" argument, I think, is not going to hold a lot of water. As defaults start to increase, as liquidity remains tight, as you go into an earnings recession, I don't care what the technicals are, spreads are going to widen. But by the way, Jonathan, everybody loves IG. We don't like that either.
Mike, I can see it in your notes. You said this: why would anyone take credit risk here? So build on that. It's not just high yield, it's IG as well.
Yeah, I mean, listen, I think probably the most consensus fixed income trade out there is investment grade credit. You look at spreads on investment grade, you can own the investment grade market at about now under 5%, or I can own a 2-year treasury at about 4%, give or take on any given day, it's a 50 basis point difference. Why would you take liquidity and credit risk going into an earnings recession when I can get lower duration, same yield paper and treasuries? It makes absolutely zero sense to us. And so we really don't like credit here. We think there will be a time, by the way, to own credit, Jonathan. And the fundamentals are not terrible. I mean, balance sheets are relatively healthy, but now is not that time. You need to be compensated for liquidity risk. You need to be compensated for default risk. And then the investment grade side, you need to be compensated for downgrade risk and business risk in general. And so far, you're not.
Zach, it's in your title, investment grade. This is your world. What do you say back to that?
We're taking the other side of Michael's view, and certainly appreciate that yields have come down a bit. But when you think about the reinvestment risk of owning a 2-year treasury versus the duration of the IG index closer to 6 or 7, something like that, I think that factors into it. And while he did mention some technical concerns, I think that there is a lot of cash out there looking for a home. We don't have as negative an outlook on economic growth or earnings as Michael seems to have. And so we think that really the income that you can earn now relative to what you've gotten in the past makes IG attractive. And we think high yield is even more attractive. Again, yields have come in quite a bit. We think the fundamental backdrop is solid. And even with a downshift, when you look at the supply and demand dynamics, demand is really coming back from the retail side. You've seen that in the first couple weeks of this year. We think that has some staying power, while at the same time, the maturity wall in high yield world isn't a concern, I'd say, in the first half or maybe in 2023 overall. So if markets can remain as open as they've been over the past couple of weeks, we think both IG and high yield will perform well this year.
Mike, have you got to come back to that?
Well, I do, Jonathan. On the high yield side, maturity walls never matter. You look back in 2008, 2009, as defaults were skyrocketing, the maturity wall was actually pushed out quite far. And so if you go back and look at prior default periods, the maturity walls don't matter. You miss your coupon before you ultimately have to refi your debt and default that way. But listen, more importantly, I prefer long duration, long maturity treasuries. If you think there's any spread widening potential in investment grade credit, then you would rather own treasuries because you're not getting enough of a yield cushion to make up for any spread widening, really. So, much of this, I think, comes down to, who you are as a portfolio manager. What kind of strategies do you manage? If you're an investment grade bond manager or credit manager, then certainly today doesn't look bad to own corporate credit risk. If you can be a multi-asset fixed income manager, to me, long maturity treasuries without the spread widening risk makes a lot more sense and give you equity-like returns.
The Treasury yields this morning on a 10-year up 2 basis points to 339. I'm not trying to start a fight over credit. That would be pretty lame. Equity futures right now down 0.7% on the S&P. Mike McKee's dropped by the studio to catch up with us as well. Mike, before we get to the Fed speak, can we just start with the economic data? Softer yesterday. And then can you please make sense of this? Jobless claims, I'll keep saying it, 190,000.
I guess I fail because I can't make sense of it. The only thing I can possibly think of is that there is a seasonal distortion. It's January when a lot of companies traditionally lay off the extra workers they hired for the holidays. And there does seem to be no real effort to lay off extra workers these days in a lot of industries. We saw that in the Beige Book yesterday. You mentioned the numbers, and the headline, of course, the one that got everybody's attention, jobless claims 190,000. We did see a decline in housing starts and building permits, and you look at the total number there for the year, it's down 3%. It's the first year of a decline in housing starts for some time. Philadelphia Fed is also interesting, not just because of the negative 8.9, which is actually an improvement it, but 24.5, extremely low for prices paid, and it looks like inflation is starting to fall, which leads us to the debate here that you guys are having and that everybody on Wall Street's having, the second derivative of what does it all mean to the Fed. On the stop side, inflation is falling. Job growth is slowing. Retail sales yesterday, very weak. And we've got this inverted yield curve that just keeps getting worse. But on the don't stop side, inflation's still too high. Unemployment is falling. Wages are rising too fast. And the key thing is this 1980 argument that the Fed stopped too soon in 1980. Inflation went back up and we had another recession. Jamie Dimon this morning saying he thinks the Fed is going to go over 5%. They still need to do a lot more, which leaves us with the fight between the Fed and the markets. That has not changed as of this morning, with Fed officials still clinging to the idea they're going to go over 5%. Susan Collins of the Boston Fed just seconds ago out with comments that they need to get over 5. They can do it slowly. She's in the 25 basis point camp, but they need to be more restrictive. And then the question is, where do they end up? They say they hold. The markets say they cut.
Yeah.
It's going to be an interesting debate over the next few months.
The pace of the journey for them set to change, but the destination hasn't just yet. Mike, thank you. Mike McKee just there. Let's go back to that. The reasons to stop, the reasons to keep going. Zach, Mike, I'd love your feedback on that. There are several reasons to stop. There are several reasons to keep going at the Fed. Stop. Inflation falling, job growth slowing, retail sales weak, very inverted yield curve. Don't stop. Inflation still too high, unemployment falling, wages rising too fast. 1980. Mike, which is it? Stop or don't stop?
We're in the don't stop camp, but that doesn't mean, Jonathan, that you have to go forever either. I mean, maybe another 50, 75 basis points certainly does the trick, and then you hold and stay restrictive for some period of time. But look at the real Fed funds rate. I mean, the Fed has really never been able to get a handle on inflation without hiking interest rates higher than CPI, and we're not quite there yet. And so I think the Fed needs to get truly restrictive. I agree with Bullard on this. Whether that's 5 or 5.25, I don't know the answer yet, but it's higher than where we are today. You know, the other thing I'll just quickly mention, Jonathan, before, obviously throwing it back to Zach, is I don't know if the level matters. What matters is the outcome. Whether it's 475 or 5.25 or 5.5, I think the market has kind of lost sight of what does that mean? If inflation's coming down because growth is slowing, it's the outcome that matters more than the level.
Hey, Zach, jump in.
Yeah, we keep being on opposite sides of the discussion here. We're more in the stop camp, and that's not stop right now. We think 25 more basis points. And when you think about the policy rate in real terms and where we think inflation is going this year, we think by, let's say, the midpoint of this year, you could have inflation running at around a 3%, maybe even in the 2-handle range, with the policy rate, if our call is correct, around 450 to 475. So that's a very real terminal rate in that case. And we think that that's going to be enough to keep inflation down, keep it, slowing toward their 2% target and remaining there on a sustained basis. And then maybe at the end of 2023 and into 2024, we can start thinking about cutting rates. So we think the biggest mispricing in the market right now is the very quick shift to rate cuts. We know the Fed has said that's not their plan. They've said it over and over again. The market hasn't budged. So we think lower terminal rate, staying there for longer, and inflation coming down more quickly than perhaps is appreciated by broader market sentiment at this point.
It's January 19th, and I think the consensus has shifted twice already in the last couple of weeks. Neil Dutter of Renmac pointing that out. Neil published just moments ago. He said in less than a week, financial market participants have gone from increasing odds of a soft landing to increasing odds of an imminent recession. Sorry, but the economy simply does not work this way. This is where Neil was at in the last 24 hours. And Mike, I'd love your view on this. This is what Neil's got to say. It's a more constructive, optimistic view on things. He said the manufacturing data were undeniably weak, but why does this continue? Aircraft and autos have a lot of momentum. The dollar's sold off, supporting the exports of manufactured goods, and global growth has rebounded. Mike, a final word on that, please.
Yeah, I think, listen, at the end of the day, it is very difficult to see an economy that's going to continue to, or I should say, expand from where we are today, given that rates are restrictive. You saw what's going on with banks. You know that lending standards are the tightest they've been since the global financial crisis. That's not an environment, especially as you go into an earnings recession, where growth re-accelerates. And so from my perspective, I'm not, terribly bearish on the economy. Like I said earlier, the economy's doing okay right now. But if Zach's right, and you got 1.5% real Fed funds rate in 6 months' time, that's pretty restrictive policy in the context of an already slowing economy. It doesn't look good.
We'll keep building on this. Mike, Zach, you're going to stick with us. Equities down about 0.8%. Hearing from the Boston Fed President, Susan Collins, this morning, saying the following: remains optimistic about a soft landing and the odds-off one. Says the slower pace of rate increases is appropriate. This is about risk management now for some of these Fed officials. She says a more measured rate hike and that address of a more measured hike from, say, 50 to 25 would help address competing risks. That from the Boston Fed President, Susan Collins. A little bit later, you're going to hear from the Vice Chair of the Fed. You're going to hear from Lael Brainerd. You'll also hear from the New York Fed President, Mr. Williams, as well. All of that this afternoon. Coming up, corporate America, running costs.
These cuts here help us drive greater efficiency, help us size the footprint. We think we're set, but we will continue to adapt to the environment as it unfolds.
That conversation up next.
During the pandemic, there was rapid acceleration. I think we are going to go through a phase today where there is going to be some amount of normalization of that demand. Quite frankly, we in the tech industry will also have to get efficient, right? It's not about everyone else doing more with less. We will have to do more with less. So we will have to show our own productivity gains with our own sort of technology.
Layoffs piling up from coast to coast. Two of the world's largest tech companies, Microsoft and Amazon, cutting 28,000 jobs this week. Cost-cutting measures making their way to Wall Street as well. Bank of America, the latest to hit the brakes. CEO Brian Moynihan saying, quote, "We were hiring to match the Great Resignation earlier in the year, and it was sort of overachieving." Shnali Basak on top of this story. Shnali, a key feature of earnings over the last week or so.
A key feature is those costs just ballooning. And remember, simply said, John, the pie is getting smaller. There's a bar on how high revenue can get. And you have headcount at Bank of America alone, which is causing a hiring freeze right now, headcount ballooning by 8,500 last year. Remember, wages are also rising here. All in all, this means the big six banks are expected to spend a record amount of money this year, $320 billion, 2/3 of that coming from labor costs, personnel expenses, compensation. Remember, technology spend is also higher on the year for many of these firms. So they're going to have to make a trade-off on these long-term investments they make versus the personnel moves they make this year as they hope to get out of a slumping market in some of these businesses. Now, remember, this really just takes you back to where you were maybe a year ago at some of these firms. So even though the thousands look very dramatic, this is after many years of boom time. So that's why it feels so hard right now. Remember, even at the mass tech layoffs, it really only brings you back to around pandemic levels because of how much the headcount has ballooned. But with tech not hiring as much, with the layoffs in the tech industry, the competition starts to get stiff for where a talent can go next, which is why you're seeing Bank of America say something like that attrition has just slowed down. There's nowhere to go next.
Shnali, thank you. Looking forward to your coverage of this story in the year ahead. Mike and Zach back with us for a final thought. Mike, it's amazing, isn't it? On the one hand, we're talking about jobless claims at 190,000, and then we've got example of example after example across a range of industries saying things are getting bad and the cuts are coming. Which one is it?
Well, I think you're going to see the weakest link break first, and tech effectively is the weakest link. I mean, what a lot of people forget is that tech companies are cyclical. And as the economy starts to slow, and more importantly, as earnings growth starts to slow, that's going to hit tech, just like it would any other cyclical. And they overbuilt during the pandemic. And so it's no surprise to us to see tech, really starting to weaken and start to see the layoffs there. Just like in credit, where, the weakest links tend to go first before it works its way up the stack. You're going to see the same thing in the labor market. Remember, labor is always the last shoe to drop. And I think that's what explains jobless claims. It's going to take some time. The labor market is strong. And this is just the beginning of what we think is going to be a weaker employment picture throughout the year. It's not going to be a quick 1 or 2 month scenario. It's going to be a 12 to 24 month scenario. Bob
Michael of JP Morgan, speaking to our colleagues at Bloomberg News earlier this week, he made it quite simple, Zach. He said the equation is this: inflation doesn't come down until wages do. Wages don't come down until employment rises. Unemployment doesn't rise until we're in a recession. Zach, is it that simple?
I think the logic is there, but I think we're going to see the unemployment rate start to rise before we're in a recession, and we've had an extremely brief cycle on the way down and on the way up. So I think that it's hard to use historic norms to kind of trace or map exactly how that's all going to play out. We think the unemployment rate has to rise from here. You're starting to see signs of that with these layoffs, and I feel like that's gotten more prominent over the past couple of weeks, past couple of months. It really hasn't shown up in the data yet. We think that's in the pipeline, and the Fed has emphasized how much the labor market needs to come in much more balance in early 2023 as they assess whether or not they can pause policy. So we think that's going to become a very important indicator, as it always has been, perhaps even more so as the Fed assesses where policy is going in 2023.
Isn't that the US risk question though right now, Zach? Do you want to be long credit risk, high yield, into an environment where unemployment's going to be climbing and not falling?
Historically, it's been a difficult situation to be long in that, but we think that when you look at yields and the type of income you can generate from fixed income, on top of the fact that there still is a lot of cash out there on the sidelines, we think have been kind of sidelined due to all of the macro uncertainty, all of the policy rate uncertainty. We think that continues to come into the market in 2023, as investors were certainly hit hard in 2022, but came into the year more or less on sides, understanding that duration was not the place to be, credit was not the place to be. There was almost nowhere to hide. So we do think you're seeing that in the first couple of weeks of this year, reinvigorated investors with cash to put to work at much better yields, which really is the backdrop of our constructive outlook.
The year of fixed income, I've been told several times. We'll work out which bonds by year end, I guess. Mike Contopoulos there and Zach Griffiths. We'll find out who was right ultimately. Equity futures right now down 0.75%. Fantastic panel to kick off the show this morning. Coming up on the programme, the morning calls, and later, Edward Jones shifting its attention to international equities. We'll catch up with Mona Mahajan around the opening bell. The opening bell about 7 minutes away. Five minutes away from the opening bell, equity futures negative 0.7% on the S&P, and the Nasdaq down about 0.8%. As the price action, let's get you some morning calls. First up, Jefferies upgrading Philip Morris to buy, saying tobacco stocks offer better returns during economic downturns. Your second call from B of A, Bank of America downgrading Charles Schwab to underperform from a buy, cutting shares by 2 notches in anticipation of the Fed ending its rate hiking cycle this summer. That stock is down by 3.7%. Your final call from JP Morgan, naming Meta a top pick ahead of upcoming results and the company's best position to weather a challenging ad market. That stock's still negative, a little more than 1% at 131.55. Coming up, some analysts at JP Morgan once called China uninvestable. They quickly took it back, and now everyone is lining up to buy. Mona Mahajan of Edward Jones joins us to discuss the growing chorus of China bulls. We are coming off the back of the biggest one-day drop on the S&P 500 since the middle of December. On the Nasdaq, we were on a 7-day winning streak, approaching 8 percentage points of gains over that period, and then we snapped it yesterday. Futures lower again today on the S&P by 0.6%. Likewise on the Nasdaq. Let's see opening bow, switch at the board and get to the bond market. What a move we saw yesterday off the back of weak data. This morning, jobless claims. What recession? 190,000 yields up 2 or 3 basis points on a 10-year, 339.87 on a 10-year. Yesterday, we dropped hard across the curve. Just remember the 10-year back in October had a little look at 434. That 433, 434 was the intraday high of the year last year. 339.87 is a monster turnaround in the last couple of months. ECB talk earlier, hawkish without a doubt. Euro dollar 108.22, firmer, stronger euro against the dollar this morning, up 0.25%. And look out crude, just about holding on to 80. That's a turnaround, $80 and about 10 cents or so. We're positive there by 0.7%. 40 seconds into the session. Here's the price action for you. We're negative by 0.5% on the S&P and the Nasdaq. We're down 0.5% also. One stock to watch at the open, Procter & Gamble. Sales falling across categories as consumers grew more cautious amid higher prices. The CEO said this: it was a very difficult cost and operating environment. Kelly Lyons has more. Hey, Kelly.
Hey, John. Yeah, this is an interesting one because actually, while revenue topped expectations with growth of about 5%, that was entirely due to the higher prices the company was able to charge. So consumers maybe are tolerant of those price hikes, but they're still buying less, or at the very least, the company is selling less because, as you alluded to, volume trends are getting worse. Volume overall fell by about 6%. That was more than analysts projected. Now, part of that decline was driven by Russia and China, but it really was broad-based. It was down in every single category, and the company was citing a, quote, market contraction for most of them. The company's CFO actually said that consumers are being more measured in their use of items like paper towels, and they're using up the products in their pantries first before restocking. So again, really this all is going to come down to pricing power, especially important for consumer staples companies, and the ability to exercise it has made these stocks a relative outperformer compared to the broader market. Over the last year, staples are down less than 5% compared to a loss near 14% for the S&P 500. For P&G, it's about 11%. It raises the question, though, John, what happens when you can't just keep hiking prices? Inflation already probably has peaked. Consumer tolerance looks like it may be starting to crack when it comes to those higher sticker prices. So then volume's really going to start to matter again. And for P&G, that trend already isn't looking great as we talk about heading into a slower growth environment. So that's likely what is weighing on the shares today, with the stock down about 2% in the first couple minutes here, John.
Kelly, brilliant morning. Thank you. So far, at least for the bond market over the last 24 hours or so, not for that stock. Alcoa is a story for you. The biggest US aluminum producer, aluminium for those of you in the motherland, of course. Alcoa down by 2.4%. Listen to this one. Last year, global turbulence negatively influenced costs for energy and raw materials, and we saw significant variance on product pricing. We're taking actions to further improve. Katie Greifeld, this did not sound good from this name yesterday, did it?
No, it was really a list of bad news from that earnings report. Adjusted EBITDA fell 97% year over year. We're talking about just $29 million in adjusted earnings in the fourth quarter. And you had the company warn that aluminum shipments will be weaker than expected. I'm not going to try to say it like you do, but there's a few factors here. You have geopolitics and higher raw materials costs. You also have lower aluminum prices because the metal fell more than 15% last year. And as you can see, that was a big weight on Alcoa shares, which dropped 24% in 2022. Since higher costs, lower aluminum prices, it's a pretty bad mix for a metals producer. And 2023 was off to a pretty solid start. Less so this morning, John. We have Alcoa down about 3.5% or so. It's bouncing around there. It's weighing on other metal makers as well. You can see Freeport, McMoran, and U.S. Steel also lower as trading kicks off. The Bloomberg Commodities Index, though, it just flipped higher, John. That would be a 9th day of gains.
Katie, thank you. A third day of losses on the cards. Never mind a ninth day of gains. A third day of losses on the S&P right now. Down 0.4% on the S&P 500. Evercore's Julian Emmanuel had this to say a little bit earlier this morning. He said the market's New Year rally has concluded. He went on to say, and while economic surprises have increasingly occurred to the downside, the deterioration is unfolding against the backdrop of the fact that no bear market has ever bottomed before the start of a recession. That line right there, no bear market has ever bottomed before the start of a recession. Evercore's Julian Emmanuel thinks that bottom is in our future, at least on this side of the Atlantic. On the other side, you've heard all the optimism on international equities, on Europe, on China. Mohit Mahajan of Edward Jones had this to say: any bout of volatility may be an opportunity to position for a gradual recovery ahead as the US dollar weakens further. It will support international equity returns. Mona, I'm pleased to say, joins us right now. Mona Mahajan, let's start right there. How compromised do you think the US story is compared to what you see abroad?
Yeah, you know, it's interesting, John. I think last year was very much a U.S. story that looked relatively more resilient given the strength of our labor market, given we weren't as exposed to the energy crisis. But as we headed towards the back half of last year and into this year, in fact, the international and European story is starting to look relatively promising. And that's not only because we did get better weather patterns in Europe over this winter period thus far, at least, which kind of saves them somewhat from this energy crisis, but also because we are seeing the China reopening story. We are seeing, as the Fed is concluding its hiking cycle and the European markets are perhaps still going a little bit further, the US dollar has weakened, which has provided support as well. So we've seen this kind of trifecta between the dollar, better weather patterns, China reopening, supporting this international story. And so we do think, you know, as the year progresses, there is an opportunity even to look beyond the IFA, but think about the emerging market opportunity reemerging. Now, keep in mind, this is also dependent on us getting through this potentially global downturn, reemerging in a pattern of better global growth overall.
Mona, can you tell me what you mean when you say EM? Do you mean China or something else? Because in the last 12 months, I've heard people call China uninvestable. Then all of a sudden, China's back in fashion. Which one is it?
Yeah, you know, I think China is a driver of a lot of local economies in that region. And so it is a lot of the Asian economies, but Europe is a large trading partner with China as well. And so anytime China strengthens, which we do think it will in the year ahead, it benefits the entire region in that area. And so we think EM is a collective of the emerging economies, but particularly exposed to China. But China is included in that EM basket as well. It's already shown a lot of outperformance. And so we do think that there's a period of stability ahead of us. But we think generally the outperformance can continue over the next 12 months.
Is the same true of Europe? And let's stick on Europe just for a while. Do I want to make a trade on Europe because it got lucky with the weather? Or are there fundamental reasons to invest in that region for the long term?
Yeah, you know, I think generally speaking, we've always seen in Europe is that the valuation discount is in play. And in fact, the valuation discount is at a high versus the US right now. And so that part of the story remains. But to your point, longer term, fundamentally, what does Europe have to offer? Well, it is exposed much more to the value parts of the market. So areas like industrials, like energy, parts of financials are tremendous parts of the economy in Europe. And if we think a value story has some legs over the next year and years ahead, Europe is an interesting way to play that. Now, keep in mind, they aren't as exposed to some of the more productive technology parts of the market. They do have an overhang in their banking system. They do have an overhang that they've been facing this slower growth, lower inflation environment for years ahead of the last 12 months. And so generally speaking, we think a trade is in place, but the longer term story does have to prove itself still.
At the index level, the absence of tech and tech exposure in Europe was a problem. Is it a problem now? Because I hear a lot of people say the index here in the United States is now compromised. Alicia Levine of BNY Mellon was brilliant on that this morning. She said it's compromised, we're going to have a change in leadership. It's no longer about the index level story in the United States. Where are you on that now, Mona?
Yeah, you know, I think the value versus growth story is an interesting one. And certainly in the 10 years post the financial crisis, growth outperformed. And that was because the Fed funds rate, many of those years, was near the low zero bound. We had 10-year average about 2% on a 10-year Treasury yield. And when we think about the environment over the next 10 years, yes, the Fed can take us from maybe a 5% terminal rate back to something a little bit more normal, but are we heading back to the zero bound? Probably not. So in that environment, we do think that there is a better opportunity for more balance between value and growth. Now, does growth have a period of maybe a bounce back in the future and maybe over the next 12 months? That is, a credible scenario. But longer term, we do think that balance is important. And so to your point, from an index perspective, perhaps, having a bit more value in your portfolios makes sense. Yep. But certainly having the U.S. With a balanced index is also beneficial.
In the short to medium term, I am wondering what rates and lower rates means for U.S. tech. Now, Mona, as you know, rates are lower over the last few months because people anticipate the economy is going to get worse. And I'm trying to understand what that means for tech stocks. Do you get the valuation relief of lower rates, or do you get the earnings challenge off the back of the reason why rates are low?
Yeah, I think generally when the economy softens, what we tend to see is a lot of those defensive plays come right back to the forefront. And so we would expect this period of defensive outperformance. And we've seen sectors like healthcare, utilities, staples, not in these first 2 weeks, but over the last 12 months, they've really outperformed. And, we would expect that defensive playbook heading into a potential recessionary environment here in the U.S., potentially globally, to come back to the forefront. And so that includes not only defensives, but perhaps shorter part of the yield curve as well. But keep in mind, markets are very forward-looking, and that's what led us to that statement saying that these are opportunities. We haven't had a bear market in several years, and in fact, when you look historically, bull markets last around 4 years, bear markets around 15 months. So we have to make sure as investors we're using those opportunities. As you position for a recovery playbook, that's when you want to start thinking about things like quality growth, cyclical parts of the market, longer duration parts of the market generally. And so we do think in the next 3 to 6 months, we'll get this opportunity to start positioning for that recovery ahead.
Mona, we're just not there yet in the minds of many people. Mona Mahajan there of Edward Jones. Mona, thank you, as always. Third day of losses on the S&P. We're down about 0.4%. Coming up, Netflix earnings providing the first read into big tech.
With the exception of Netflix, everybody is losing a lot of money.
That conversation still ahead with Michael Nathanson of MoffettNathanson.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Michael Asciano, Portiolo's CEO and president of Balance of Power. This is Bloomberg.
With the exception of Netflix, everybody is losing a lot of money. In the case of Netflix, they are profitable, so they are at a completely different level than all of the other traditional media companies who've kind of joined the party later.
Netflix kicking off big tech earnings after the closing bell. Shares nearly doubling since its May lows, with the bulls looking for another leg higher. Analysts counting on the company's ad-supported plan to drive revenue growth. Morgan Stanley raising its price target ahead of those results, following raises from Oppenheimer, Wedbush, UBS, and a buy rating from Jefferies. Kaylee has more. Hey, Kaylee.
Hey, John. Yeah, for this company, it's a question of how high the bar is set, because it's going to be all about subscribers as usual. The estimate on the street is 4.5 million additions in this quarter, which matches the company's own estimate. But it also, in addition to subscribers, is going to be about the company's attempts to generate other revenue. And really, as you mentioned, that ad-supported tier, which launched in November. It is cheaper and theoretically could help reduce churn. So we'll get a view into how much early traction that tier is really getting and how much the company benefited from its content slate with hits like Glass Onion and Wednesday and the Harry and Meghan documentary that I got through 3 episodes of and didn't finish. And we'll have to talk about how high the company needs to really deliver on the move we have seen in the stock. You alluded to it, John. This is a stock that has nearly doubled since its lows back in May of last year. It's up more than 90% since that time. And of course, the issue back at that time was the fact that you had subscribers going down. There was real questions about the company's long-term growth. So we're going to see if this new model perhaps is working in its favor. And just one final word on the stock and the potential swing we could see. Off of these results today, option markets are pricing in a move of greater than 10% to the up or downside on earnings, which is the third largest implied move of any company in the S&P 500. So this is not only going to be the real first test of big tech results, but really the first potentially big mover of earnings season more broadly, John.
How did you get through one episode of that? That's
I got
what we all
through
want to
3.
know.
I was on an airplane, you know,
Oh, right,
kind of stuck.
Okay, blame travel. All right, Katie, thank you. I'm not getting drawn into whether you should watch that or not. I haven't watched a second of it. Katie Lyons on the latest with Netflix and some other stuff in there too. MoffettNathanson raising their Netflix estimates ahead of the results. Michael Nathanson boosting his price target to $240, expecting tailwinds from a weaker dollar to bring forecasts above consensus. Michael joins us right now. Michael, let's start with the numbers later, and then we can get into the bigger theme as well for some of these streaming players. Tell me what you're expecting a little bit later this afternoon.
Okay, we're expecting, as I said, currency is a big tailwind here. They have, all their programming costs, majority of their programming costs are in the U.S. So as the dollar weakens, they really benefit from weakening dollar. So we'll hear about that. You'll hear about, we think, an inline quarter on subscribers, but they're going to spend time talking about password sharing crackdown, right? They've said they're going to talk about their plans to stop people from sharing passwords. And then you'll get some updates on advertising. I still think advertising is early days. Our view is the stock's a bit ahead of itself here. But I think this has become a story stock around password sharing, advertising, and then, what we're saying is a third act of streaming where you'll start to see consolidation within media, companies of spending less money on streaming. There has to be some rationalization here. So I see this as a story stock, and it's ahead of itself in our view.
Talk to me about that consolidation, Michael. Where do you see it happening? Which dance partners?
Well, here's the problem, right? So we think there are 3 companies, 3 platforms that are going to be subscale: Peacock, NBCU, Paramount Global, and HBO Max, which is owned by Warner Bros. Discovery. They have to get together somehow. Problem is, you have regulatory issues, you've got control issues, but someone has to decide to combine, maybe create a joint venture. We don't see the path in the near term. It doesn't seem very likely. So the problem you have is you have too many competitors chasing what is a slowing subscriber base in streaming. So it's not clear for us how that dance card plays out, but it seems logical that you can't keep throwing money at this business with the returns on capital being as low as they are.
Michael, can I just throw this question at you? Tom Keene and I were talking about this morning. Has this quickly become just a really crappy business model?
Well, Jonathan, we've always been doubters, right? Like, we've always been asking people, saying the same question: is streaming a good business? When people say Netflix has made a lot of money, they've only had free cash flow positive 1 year before this year. That was in the pandemic. So it's not a good cash generative business. We've always said that. And I think the past year we've had the market start to look at it the way we have, which is you have to spend a ton of money on content. There's high churn. It's hard to raise pricing. And there's just so much competition, right? So I think this is a sub-average, subpar business. I really do.
So you've talked about the massive penetration we've already seen in the United States. You mentioned the importance of the US dollar. Is the international side of things the only growth play left for this business, Mike?
Big TAM opportunity. Yes, it's developing markets, right? So it's India, it's Latin America, it's parts of Eastern Europe, right? It's Asia Pacific. The most of the Western, Northern European markets are at a level that you could argue they're mature, right? So you need to grow into other markets that have much lower revenue per user, right? We're seeing that everywhere, and that's the challenge here. What Netflix is going to do correctly is they're going to try to get more money out of the bases in Western Europe and the U.S. where there's password sharing. They're going to introduce a lower ad product to get some of those markets where there may be some economic challenges to sign up, right? They're doing the right thing, but we've been saying for the past 2 years that we see penetration as peaking in Western Europe and North America.
I've been complaining about this for a while. You and I have been talking about it. It just feels like this has quickly become the old cable story, Michael, that everyone complained about, and now they've ended up with something that looks like the old cable story where we're still spending too much money on content.
And you would say, Jonathan, as a consumer, it's suboptimal because you have to go in and out of different apps.
Drives me nuts.
Yeah, it drives you nuts. And I heard the conversation about Harry and Meghan. I started 2 episodes. I kind of forgot about it, and it's kind of lost in my, within my catalog of things I want to watch. Right? It's not a great product. We're waiting to see. I think the story that you'll be asking us in the next year or two is, who's that aggregator? Is it Google? Is it Amazon? Is it Roku? To put these bundles, to create a new bundle, right?
Yeah.
It seems logical. It really does.
It's ridiculous that we're there because we joked about it for so long. I want to finish on this. Michael, I went through some of your calls. This is interesting. Buy Google and an outperform on Meta too. So you've got a buy on Meta, you've got an outperform on Google. Can you tell me why you're so constructive on those two names when everyone is worried about whether we go into recession, the decline of ad spend? Why do you like those two?
Because I think what happened, Jonathan, was that 2021 was extraordinarily good. And 2022, they're anniversarying a literal bubble in ad spending, right? So I understand the economic worries to be ahead this year. But I think what people are doing is that they're looking at 2022 and saying, well, the business is structurally broken, right? It's all behind you. And I'm arguing that in 2021, you had an abnormally great year. 22 is lapping that. You will have economic risk and probably risk numbers in 2023, but the multiples have come back so much. In Meta's case, they trade at 10 times earnings. And I don't think their business is as broken as the world thinks, right? I think it's a comp issue from 21. So that is the heart of it, right? And you know, I think they've all pivoted to try to take on TikTok, and that's hurt them on the revenue side. And I think you'll start seeing monetization of, you know, Reels and YouTube Stories. Yeah, so YouTube Shorts. So to me, if I can buy a company trading at 10, 11 times versus 30 times, Jonathan, I know there's earnings risk. But you know, as you used to ask the last guest, you know, I think you have like 3 months to go before numbers are in the right place. And then these stocks will look so cheap. So that's why we maintain the buys on them.
Let's catch up again before or just after they've reported. I'd love to do that. The control room, I can tell you, Michael, is just shocked that you watch Harry and Meghan, and I'm very impressed you managed to forget that you did that. So thank you, sir.
Well, thank you, my wife. I had to do that.
You've got to do what you've got to do, I understand. Michael Nathanson, thank you, sir, as always. Coming up on this programme, we get you the trading diary. Equities right now down 0.7%. Another day of declines, another morning at least. On the Nasdaq, we're down about 0.9%. Your trading diary up next.